in the West at least, that big tech would really monopolize financial services. The largest percentage of fintechs or bankers that are using AI in lending, wealth tech or fintech has really commoditized a significant part of investing. A Bitcoin could become part of the holdings of a central bank. Institutional interest in cryptocurrencies and digital assets, broadly speaking, I would say remains quite solid even in this bear market.
Today, our guest is Dr. Efi Pylarinou, one of the world's top thought fintech leaders, global tech influencer, experienced Wall Street professional, and prolific content creator. Efi, good afternoon, and thank you for being here.
Good afternoon, Denis. It's great to connect with you.
Let's look at fintech from different angles. Efi, in which areas have fintech failed or had difficulty to scale over the past years?
I would say that the first failure that comes to mind is this mantra from the early days of fintech that they would replace consumer banking. They would get rid of banks, whether it was self-drive money or the digital neobanks, that they would be replaced. There was a war out there for a couple of years, and the truth is that traditional consumer banks are here. They are competing. They have been gifted the gift of competition, and they are striving to transform digitally. And I think the big failure from the fintech's perspective is they underestimated the difficulty and the high cost of acquiring customers. The cost of acquiring customers and their technique to acquire customers, their ways of acquiring customers, honestly was no different than what the traditional banking providers deployed. Different offerings, mails, mass mails, advertising, and so on. The other failure was that the wave of robo-advisors and digital investing, that was another big mantra and a war that was started in the US with Betterment and Wealthfront, especially Wealthfront, the very hardcore self-driving money founder of Wealthfront. The truth of the matter is that none of these businesses have been sustainable, profitable, standalone businesses. They have been leapfrogged by the incumbents. Look at Charles Schwab offering, $30 advice per month and a $300 annually subscription package, and having, let's say, I think the incumbents in terms of robos have 80% of the assets today. So what has failed is the standalone version. They have succeeded in transforming the sector, but that is their failure. And I don't want to mention how many of the robo-advisors had to close down in the meantime, with one of the most recent ones being Motif. The other fintech failure, is in the peer-to-peer lending space. That if you look today, there are few of the original peer-to-peer lender providers, from Lending Club to Prosper and so on. And if we look at the UK, one of the first and very important UK peer-to-peer lending providers, Zopa, that is, I think, 15 years old or 16 years old. They have been obliged to close down their peer-to-peer activities, which had about 60,000 customers, and they've basically pivoted to banking. So that is a proof of the failure of the big vision of peer-to-peer lending. I mean, China also, their peer-to-peer lending failures there is another tainted part of the fintech history, but there it is the lack of regulation that created that fintech disaster.
In which areas of fintech are they involved? And can we say that there will be a complete monopolization in the future?
In the West, the big techs, the GAFAs, Google, Apple, Facebook, and Amazon, I would say that they're primarily and traditionally been involved in payments. And, payments, again, they're not boring and they're not simple. For me, the GAFAs are focused on really delivering contextual payment experiences. They're not in the business, to earn the interchange fees or anything. Really, it's about being able to create contextual payment experiences within their ecosystems. And a great example is looking at what Amazon has done to date, and they have been very early in payments many years. So fast forward to today, and Amazon not only offers a rich digital wallet as we understand it today for customers, but also a payment network for its merchants. And its merchants on its marketplace is a very important part of its business, and therefore enabling them with digital tools is very important. Again, they're into payments to provide contextual experiences to their retail customers and empower their merchants. Amazon is also innovating with technologies and with their patent or their patented technology of Just Go technologies that they're using in the Amazon Go stores, where you can walk in, take the merchandise and walk out, and you need to do nothing in terms of payments, frictionless payments with biometric technology and so on. And no wonder Amazon has been invited by the European Central Bank to be part of their digital euro project. Why? Because they want them to develop e-commerce payment prototypes for the digital euro. So you see how they're involved in payment experiences. If we look at Apple, the Apple Wallet is also an important part of fintech, and especially with their ability in the US to hold the digital identity, the driver's license, they have a huge advantage in terms of the customer experience in payment. But let's not forget that Apple also announced recently the so-called breakout plan, which is about building in-house payment rails. And the reason they want to do that, in my opinion, is they want to cut ties with the card networks and be able to create personalized customer experiences that are bundles of hardware and software that they offer, because software is a high margin business for them and they want to grow it both for retail but also for merchants. On the other hand, if we look, big tech has been involved in credit offerings, again for their merchants' loans, but it's mainly through partnerships with banks. Amazon and Apple are examples, but I don't see that growing. I would also say that what Google has done with their recent failure to launch Googleplex, which was supposed to be the checking account and was really well received from the market. There were surveys and people expected a big success upon launch, and they finally decided to stop it. So that shows again that there is a difficulty in really monopolizing and being afraid, in the West at least, that big tech would really monopolize financial services because of this embedded finance possibility. We have not seen that, and it seems that it's much more difficult than it appears. Even Apple, with their buy now, pay later offering and the separate financial subsidiary that they launched for that, they are delaying that, so we see the difficulties. On the other hand, if we look at the East, the big tech there, the bats, Baidu, Alibaba, and Tencent, they definitely have been involved and have been monopolizing the financial services there because there was a huge need and because there wasn't any regulatory restriction. However, the regulator now is obliging them to break up entities and separate them. Baidu has actually done it a while ago, and they're continuing along that path. I do not foresee regulators being kind in the West either with the big tech. I mean, let's not forget the failure of Facebook, Meta, with their Libra project and their DM project that has completely failed, has been shut down, and has actually gifted the whole economy this growth of interest that goes beyond interest, of research into central bank digital currencies. So we have to ironically thank big tech in the West for pushing jurisdictions and governments to finally say, you know, we have to take it in our hands and not let it be something developed by the private sector and the big techs.
Let me remind you, my name is Denis Astapchenia. I'm Head of Financial Technologies at Andersen IT Company. Our Research and Development Department works on the content for this channel and also collects the best practices of FinTech software development. You can view the examples of such case studies on our website. The link is in the video description. If you need to go digital, cut operational costs, or automate business processes, we will offer the best possible solution for a business case. Contact us. So AI in financial services. Efi, where in financial services AI is currently implemented and for what purposes?
There's a very wide range of use cases, starting from the ones that are for consumer-facing purposes. I would say that the first use case was and is about chatbots at call centers, really leveraging natural language processing. And then the next level is for PFM, personal financial management, where AI sends notifications with budget tips, spending tips, notices about predicting cash flow shortages, overdraft fees, and so on. Then there's a big use case on onboarding customers, KYC, AML, being able to do that 24/7 and seamlessly. Advanced use cases for fraud detection and cybersecurity. And then the next big one is really in the lending space, that we have diverse use cases of AI, compliance on all verticals, compliance in consumer banking, compliance in the wealth space, many AI cases there. And then I would say in the B2B, there are very interesting and more sophisticated AI use cases in research, in investment banking and corporate finance and capital markets, trading algorithms, risk management in asset management is a case not new, but more use cases in supporting the role of chief financial officers, CFOs. Their role and importance in the corporation has changed, and AI is helping. And of course, in insurance, credit claims, and so on, I think that's one of the other big AI use cases.
Credit is the fuel of any economy. So could you tell us more about the different ways of using AI in lending?
Lending has mainly been used for credit risk. And I would say that the largest percentage of fintechs or bankers that are using AI in lending today are doing it at the origination level. So really assessing creditworthiness of new customers by using alternative data and gaining insights at the origination level. Fewer lenders are taking AI to the next level, which is about credit risk monitoring of existing portfolios, of existing customers, to see if their creditworthiness is changing, to notify them before they become delinquent by the predictive abilities of AI in terms of, their cash flow management, and also in terms of collectibles. I would say those two use cases are a little behind, but they are growing. In terms of this second growing part, I would say that compassionate lending, as in helping customers repay their loans before they become delinquent, and maybe restructuring by using AI and customizing repayments or proposals of how to not face these difficulties. That is a big area that AI will be used more again in this tough macroeconomic environment.
Efi, could you provide some practical examples of the successful AI implementation?
One of the most successful examples of using AI comes from the East, looking at my bank, which is part of the Ant Group. They have been providing millions of collateral-free loans to small businesses, and they have done that with AI 100%. It is the infamous 310 loans, which means it takes 3 minutes for the loan application, 1 second to approve or disapprove, and 0 human interference. I think really this is the best example of deploying AI at scale in the credit context. If we look at India, there's a great fintech called Zest Money, and they provide the tech stack to use AI and evaluate the credit worthiness of people with no credit. There are many in India with no credit history, and they use alternative data and AI to profile these customers and accordingly decide, credit limits and size that. Another great example in the personal financial management space is the chatbot of Bank of America, Erica. Erica is so successful and proved its success during the COVID crisis, but in 2023, it is predicted that Erica will save Bank of America 1 billion hours of human, work hours.
Hard to imagine the number.
The number is really mind-boggling. And there's more such chat box coming from, for example, Bank of Montreal. They have what they call the Cash Track Insight, which notifies customers about cash flow problems in advance or price hikes in their subscriptions. So we see these personal financial management use cases. Fraud is a very big one. I would say that JP Morgan, that processes a huge amount of payments, consumer payments, they have implemented proprietary algorithms to really detect fraud at the consumer level, and especially with using credit card data to detect that fraud.
What about specific AI providers that enable the use cases in financial services?
Tech providers that come to mind, the first one when I think of AI is NVIDIA. NVIDIA is really very much focused in financial services on enabling explainable and trustworthy AI, which is extremely important in financial services because we don't want AI to be making decisions, for example, around credit worthiness in ways that are biased, in ways that are not explainable. Microsoft also is very much involved with their Azure cloud offering and in collaboration with, for example, Backbase and Finastra, and they have been working on several use cases in the mortgage servicing industry in the US using AI. In terms of chatbot AI and the use cases, some of them are already mentioned around, personal financial management. One of the successful names is Casisto, which is exclusively offering chatbot technology for financial services in this area. In, I would say, regulatory compliance, a huge, ever-increasing, ever-changing area. Think sanctions, think new regulations. Companies like Cube out of the UK are using AI and machine learning for this purpose. Comply Advantage is really specializing on financial crime. They are 100% AI driven. KYC and identification services, very important in financial services. Trulio is a name that comes to mind. I mean, the cases of AI in FinTech is really very, very broad.
Obviously, fintech has helped to reduce the number of people who didn't have access to banking services, as well as those who are underserved. So most of the work has already been done, right? In other words, have the main problems of the financially excluded been solved?
I would say that there's been progress in terms of financial inclusion. The top number right now of people that do not have a bank account, I think according to the latest report from the World Bank, is 1.4 billion, down from 1.7 billion 3 years ago. But at the end of the day, we don't care about bank accounts. What we care about is whether people have ways to send money and pay their bills, whether they do it through a bank account or a fintech. It really doesn't matter. So fintechs have helped a lot on this front. They've also helped people that have low or no credit history to avoid or at least reduce their interaction with payday loans and build a credit history. But the problem is not solved. And the evidence I see is, look at how many offerings of early wage access we see in the market. Nearly all fintechs are offering in the US early wage access. And we see also banks starting to integrate early wage access. What this tells me is that there is a problem. We have a population in one of the most developed countries with an increasing part of the population living paycheck by paycheck. And this is going to get worse. And we're talking about people that are not unemployed. There are people that might be earning even 100,000 a year. So we need to provide more services to the underserved. That, unfortunately, is a growing problem rather than a shrinking problem. So to me, it seems that ideally we should be streaming money. I mean, think of what Lyft and Uber are doing by giving their drivers their earnings on the spot. We should be able to do that. And we're not there. We still have also big parts of the populations, like, for example, in the Philippines, in Vietnam, in Mexico, that remain underbanked, meaning they cannot pay their bills and take hold of their earnings and manage their financial lives. We need to continue thinking around the necessity or not of a universal basic income for those that are in need. We need to think what financial inclusion means. What does it mean? Doesn't it mean that we are able to direct capital where it is needed? Do we need programmable money to do that effectively? Those are the questions that we need to ask ourselves in order to design and distribute flows where they are needed. So we have progressed all in all, but there's a lot of work to be done along the lines of financial inclusion of the underserved and filling the needs where they are in real time, if possible.
Interest in asset management technologies, the so-called wealth tech, continues to grow. Why does wealth tech pose a threat and opportunity to conventional players in the asset and wealth management space? And what are the hottest trends in this area?
The reality is that wealth tech or fintech has really commoditized a significant part of investing. Think robo-advisors and commission-free trading. They have contributed to the reduction of margins and the democratization of access to a large part of the population. Especially in the US, as I mentioned earlier, we see even subscription packages that have zero commission offerings, so no fees to invest, plus some advice, and there's a subscription for anybody. This was unthinkable 5 years ago. We are customizing and designing hybrid models around digital advice. We are at a stage where fractional investing, which is clearly democratizing access, is quite standard. We have wealth tech providers that are offering this, and it can be embedded anywhere. The wealth tech industry has transformed investing and wealth management in several ways. We have digital onboarding, now it's standard, automatic rebalancing of portfolios and access to low-cost investments. That's also standard, and that's been accomplished through wealth tech. The customer expectations have changed. So customers not only expect more transparency in the fees, because before there were a lot of hidden fees in the investment management sector, so that's a big change. They also expect access to investment opportunities, research, and tools that before were only available to high net worth or corporate clients. So we have the democratization of investing. What does this mean in practice? We are seeing, for example, private markets being accessed by retail investors, either through tokenization. This is very prevalent in Asia, tokenizing private equity funds that typically have minimums in the millions, and now they're tokenized, and accredited investors can build a diversified portfolio with minimums of, let's say, 10,000 or 20,000, the same with hedge funds. We are also seeing in Southeast Asia embedding wealth in the super apps, so wealth as a service, and this is at not the sophisticated level, but it really democratizes access to investment opportunities. In the US, which is a much more mature market, we are seeing the large incumbents offering powerful digital tools to their financial advisors so they can serve better their end clients. Morgan Stanley is a great example of this with their so-called next best action platform for financial advisors, where they have integrated a full suite of digital tools that is really powerful. In my opinion, they are the most advanced in integrating tools, sophisticated as much as including risk management tools at their fingertips from the BlackRock Aladdin system that they use. And let's be clear, a lot of big banks use BlackRock's Aladdin risk management system, but that doesn't mean that it's integrated with their wealth management business. So integration is a very big differentiating factor. Bank of America has its own integrated holistic offering that's called Life Plan. which is for customers to manage their financial lives in a more holistic way. This is an integrated wealth tech offering that is enabled through these technologies. I would also add that wealth tech technology is opening up a huge blue ocean, an opportunity to serve at scale the so-called Henrys. Henrys are the high earners not yet rich that could not be served by the wealth sector. Here we have the opportunity to profitably serve them with service that was only possible within the private banking sector and the high net worth individual. Actually, Oliver Wyman sizes this opportunity of serving wealth tech, serving the Henrys, as big as $230 billion. So wealth tech is a huge opportunity opening up to serve at scale parts of the population that we were not able to serve them. I would add also that the relationship between asset managers and wealth managers is shyly changing, and this will unlock a lot of value. If asset managers are data enabled and connect with data enabled wealth managers, then really they can co-create not only personalized investment products, but really experiences for their clients that are personalized towards their financial outcomes and goals. And that is really where the gold is. Data-enabled asset managers and data-enabled wealth managers within an ecosystem.
I have one last topic, which is blockchain and tokenization. Efi, Bitcoin was first recognized as an official currency in El Salvador, and the Central African Republic joined on April 25th. Will this trend become global?
Clearly not, especially in this bear market across all assets. I think the realization that of the value, rather, of a lender of last resort is important in these markets, in the cryptocurrency markets. However, a Bitcoin could become part of the holdings of a central bank, much like central banks hold commodities or stocks as part of their reserves. And the reason I say this is because of the, I would say, monumental or one-of-a-kind freezing that happened this year to the holdings of the Central Bank of Russia at the US Federal Reserve. This for sure has reminded all central banks of the importance of self-sovereignty. It's become clear that holding assets, holding reserves in your own sovereignty can be an important factor to consider. Look, the cryptocurrency market, as you mentioned, is a market that grew up from retail. But the last 2 years, I would say, there's been considerable interest from institutions and traditional players, even in DeFi, decentralized finance, last year.
The cryptocurrency markets have traditionally been dominated by retail. Institutional interest from traditional players has started to become significant since last year, even in DeFi. So what is happening now, and what do you foresee in the future, since 2022 has wiped out over $1 trillion of the total market capitalization of cryptocurrencies?
Look, institutional interest in cryptocurrencies and digital assets, broadly speaking, I would say remains quite solid even in this bear market. Honestly, there hasn't been a week that goes by that I don't read quite important news that are around a product that's been launched by institutional investors, or a plan to launch or to partner with a crypto native player. When I look at the space, I think, of Fidelity first. That was an early player, serious player, participant committing with their digital asset division back in, I think it was 2018. And they continue to develop their expertise and their offering. It's not only custody, it's not only investment products, it also includes a professional trading platform. Recently, BlackRock launched a private fund focused on Bitcoin. A lot of headlines around that. The CME continues to roll out futures offerings, different underlyings, different dates, and so on. I would say that the custody business is a very significant subvertical of cryptocurrencies in which institutionals have been interested and continue to be interested. And there are two choices. Some have built their own capabilities. Nomura's Komainu, if I say the Japanese term, platform is very well known in-house built custody offering. Standard Charter also offers, I think the name is Zodia. They are built-in custody platforms, but many players are partnering with crypto natives and offering custody, from Citibank, that is going to work with Metaco. State Street is already working on an offering. I don't recall, I think it's with Circle. Yeah, the custody is with Circle.
Efi, what are your thoughts on tokenization? Following UBS example, how soon we will see banks start tokenizing their clients' assets?
I mean, personally, I'm very excited about tokenization. I was pretty impressed with one of the latest news of KKR, the big private equity fund, tokenizing a part of one of their funds on a public blockchain. I knew Partners Group had already tokenized one of their private equity funds in collaboration with a Singapore FinTech in the business. I think those two moves are pretty important, democratizing private markets through tokenization. These are huge markets that have already been proven and accessible only to limited investors, and now they're being tokenized. I must mention the Swiss exchange, the Swiss Digital Exchange, which is the first regulated digital exchange that is already operating and offering the technology to launch tokenized equity and debt instruments, very important. And then in more of a pilot phase and running parallel to their existing business, DTCC in the US, the clearing and settlement entity, is already working on the so-called Project ION, that is about settling and clearing equities at nearly real time. I'm a little cautious on what happens with that and how soon it will be launched, because we are all aware of the fact that Australia, the ACX exchange that was supposed to be a huge success and was an early player in the space of tokenizing equities. They had the advantage of owning their settlement system, CHESS, but they have failed to deliver. They've been working with digital assets, and nothing has happened. To date, I would say that it's happening. We need time to make this really work, because we need the network effects. We need to build infrastructure, not only for the origination of the tokens, to tokenize something, equity, debt is fine. You need the infrastructure for the life cycle management of those, assets, the digital assets. There's a lot of work being done in the US, and the infrastructure modules being put together. We have to be patient and keep in mind that we want to use this infrastructure really to unlock value at the infrastructure layer, always for the underserved. Underserved has a broad scope. It's underserved with respect to, paying their bills, but it's also underserved with respect to managing their investments, access to capital, anything that is a goal in their financial life, be it an individual, be it a corporation. Changing the infrastructure to facilitate these goals, these outcomes at scale is really what FinTech should be about, and should always focus on that mission.
Efi, what books could you recommend to our viewers and listeners, and what do you keep at your bedside table?
I am a big fan of physical books, although I do have my Kindle. I've had it for a long time, and I love it, especially in the summer, where I go back home and spend, I think, 2 months and work out of there, and then I don't have to carry books, or I can download a book and so on. But I love physical books. That's one. So I usually have a stack of 2 or 3 books that I'm reading, and they're a mixture. Some of them are pure finance. Some of them are more futuristic tech. And the third category is what I would call more around my personal introspection and self-awareness. So, right now I just finished reading Brett King's book, which is a one...
Technosocialism?
Yeah, technosocialism. So, put it in the category. It's kind of in between, right? I would say tech and futurism and so on. And I've read Paolo Cironi's recently. It was my last FinTech book. I'm looking forward to reading a book which is around how digital twins will change the financial industry, and that's a book from John Blick, who is in the financial services, multiple times author, in working in Australia. And then on the self-awareness side, I'm reading the book The Path of Integrity by Martha Beck, which is really about integrity is about being true to yourself and what that means. And I'm also listening to an audio book by Samad, if I'm saying his name correctly, called Positive Intelligence, which is about how to manage our emotional intelligence and identify our saboteurs in our personal and work life. And really, to me, this is what does empathy mean and how to really use it in life. So I need this mix. And I must also confess to you that I'm an author myself, not only of finance books, especially when I was on Wall Street. I collaborated 2 times with Frank Fabozzi, where we wrote books on emerging markets and so on. And I contribute to books now in FinTech and finance quite frequently. But I'm also an author of a fiction book. Unfortunately, it's in Greek, and it's all about cynical, satirical view of life on Wall Street. And I always like to be a little cynical, satirical, because I think that's the best way to deal with our lives and self-reflect.
Efi, thank you very much for sharing your ideas and talking to Andersen.